Did the housing market just become political? Looks like the Fed is dipping their toes into the market once again. So, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Today is the 2nd of May. Starting off a new month, hope you are doing well. This video is brought to you by our friends at Foreclosure.com. If you're looking to find distressed properties, go to gethousingdata.com. That's gethousingdata.com. You'll check out the distressed properties in your neck of the wood and your zip code, etc. All right. So this is kind of interesting. We're going to get into this, and I don't really relish having this conversation because I've tried over the past few years to sort of keep we'll call it political commentary off the channel because I don't really think it's appropriate. The problem though is that I think as time goes on, the government, when I mean political, I don't mean, party versus party. I mean, whoever is the government in charge at the time trying to dip their toes into the real estate market. So what we've seen over the past few years, and I've got some experience from this back in the last housing crisis as well too, is the increased government involvement in real estate. Okay, so how does that sort of happen? Well, we have landlord and tenant laws. So various states and even various metro locations across the country have certain laws that sort of operate in the scope of landlord versus tenant, etc. So those laws are increasing. Those laws are becoming, depending on what state or what metro you live in, could be more onerous to the landlord. And again, it's various levels. It could be the mom and pop small investor to the corporate people with multifamily. But the point, though, is that we got a lot going on in landlord-tenant world. Obviously, foreclosure laws. So each state has its own statutes on how foreclosure laws run. I've noticed over the past couple of years, especially say in California, they've changed some of the laws regarding bidding process and what happens afterwards, with respect to the foreclosure process in that state. We've seen, obviously, with the pandemic a couple years ago, we've seen a moratorium. So we have various moratoria that was enacted across the country back a few years ago. As a matter of fact, there's still the odd location or county that do have moratoria in effect. We see that with respect to foreclosure activity, foreclosure auctions, and especially the evictions too. I'm not too sure about this, but someone could correct me if I'm wrong, but I still believe that Los Angeles County may still have a landlord type eviction moratorium in place right now. So the point though is that governments are getting involved, but when government gets involved, typically there's maybe the desire to do well by the people, but it ends up hurting another segment of the population, and it doesn't work out for them. What I found over the years that you penalize the smaller mom and pop investors, you restrict the actions of the small investors, and by doing so, they sort of handcuff or tie down the small investors' activities, but in turn they turn a blind eye towards Wall Street, hedge funds, real estate investment trusts, the big buyers, the money people. And that's all based on, quite frankly, lobbying, donations, politics, the whole bit. The problem is the small mom and pop investors, they're not in a situation where there's a voice that can be heard at the state or the national level. So the question is, what's the end game here, and who really benefits from all this? So what has just recently happened, so we're going to talk about today, is we're talking this mortgage equity program has begun. So starting May 1st, starting yesterday, this new program is in place regarding mortgages. The gist of the program, and I suggest that you look it up, especially you can go to some of the websites that explain this in greater detail, but the gist of the program is that if you have a better credit score, a good credit score, you're ultimately going to pay more for your loan than somebody with a lesser credit score. So essentially, and as I said, I want to be clear here, this is not politics. I'm not working the politic angle here. This is just what's happening in the headlines. So Biden punishes responsibility as new mortgage equity program begins. Starting today, which was, the Federal Housing Finance Agency's mortgage pricing adjustments will increase fees for borrowers with high credit scores while reducing costs for those with subpar credit scores. This upside down policy is blatantly socialism, and one can't help but wonder if anyone in the Biden administration learned anything from the subprime mortgage meltdown that occurred more than a decade ago. Part of the plan is to make housing affordable for everyone. We've seen the story before. And basically, borrowers with high credit scores will pay more in fees, while those with lower credit scores will pay less. So ultimately, the better the credit score, you'll pay more in fees, which will help to subsidize those with lesser credit scores. Thus, the whole point, making homes more affordable. What's the genesis of this? Well, with homes and real estate being unaffordable, we have an affordability crisis with higher interest rates. It's proven that a lot of people who are either lower income or lower credit score can't get a leg up in buying a property. So I understand how that plays out. We all do. But what you're doing, or what they're doing now, is basically saying we're going to give preferential treatment to make it affordable as best we can for other people. So not other people, but people with lower credit scores. So, the thought process is great, create some programs, but now the people with better credit scores are going to pay for that. So really, this is called loan level pricing adjustment. And ultimately, if you think about it, what's the benefit here? So what's the incentive now to have good credit? What's the incentive to put, a good chunk of change down on your home purchase? Well, it doesn't work that way anymore, or it's not required anymore, because now people with lesser credit scores, can jump in as well. So I'm trying to say it the right way here. I look at everybody's entitled to a home, and everybody's entitled to make a purchase, and the real estate in itself doesn't discriminate on a number of different levels, right? That's the Federal Housing Authority and the laws that go along with that. But now we're into a situation where it's not a discrimination situation here. It's a subsidy. It's a subsidy is being created. So people with better credit scores are now required to subsidize those with lesser credit scores, which, when it comes down to it, it's not really the fairest thing in the world, and does take, as they say here, the backlash over the loan limit changes has prompted the FHFA to publish a statement last week calling such concerns a fundamental misunderstanding. The administration assures that new changes are meant to help those with poor credit scores obtain homes amid the worst housing affordability in a generation. According to FHFA, the new adjustments will redistribute funds to reduce the interest rate costs paid by risky borrowers. This sounds like socialized home buying to us. All right. Going back to the thought with respect to they didn't learn anything from the last housing crisis. Well, if you think about what was the mortgage meltdown. So the mortgage meltdown, which was the subprime mortgage crisis, did kind of kick off the last housing crisis. And the whole point there is that there wasn't a subsidy going on, but there were option arms. So people basically were able to get into home buying scenarios with lower interest rates. Those rates increased based on adjustments because they were adjustable rate mortgages. So once that happened, it was proven that those buyers who bought with these low enticing rates on their option arm mortgages couldn't afford when things adjusted and rates became higher, and therefore payments became higher. Okay, so they're saying the administration is subsidizing irresponsibility, rewarding failure, and discriminating against people with high credit scores. So that's the premise. Is it tough to disagree with that? It is. Meanwhile, 27 states revolted against the mortgage redistribution rule to subsidize risky borrowers. Breaking 34 state financial officers from 27 states have signed on a letter to the president or administration demanding that they end the new mortgage equity program, which forces buyers with good credit to pay higher rates to subsidize loans for riskier borrowers. So again, you're going to have people on both sides of the fence on this. Obviously, to me, the American dream has always been owning your own home. So, are programs good to get people down that path to own their own home? Certainly are. It creates stability, it creates, community, it creates growth and involvement. But the point is, somebody has to pay the price down the road. Back in the last housing crisis, it was offering loans that didn't make sense, and we had a whole foreclosure mess and the housing crisis that came afterwards. And who bore the brunt of that? The American taxpayer did. All right, and there was bailouts and the whole stuff. Let's not forget what happened. It was irresponsible. Are we going down the same path of irresponsibility now? Tough to say. Obviously, Rep. Tim Scott slams new federal mortgage rules punishing Americans with good credit scores and urges voters to reverse the curse of the current administration. So you're going to see a lot of political rhetoric, again, on both sides of the fence of this. Biden's mortgage scheme will cost homeowners an extra $30K for having a high credit score, punishing responsibility. While the changes may not be as bad as some headlines suggest, it still seems illogical to essentially penalize fiscally responsible borrowers in an effort to assist less qualified borrowers. There you go. There's no logic here, just progressive bureaucrats enacting policies that may ultimately lead to a future crisis. So that's the whole point here. So, are we stoking the fires and just accelerating future crisis? Well, that is up for debate. You may think differently. I think that all contributes to a future crisis. But by the way, if you enjoy the information I provide and my commentary on what's going on in the housing market, if you could please hit that subscribe button, I'd really appreciate that. And if you're currently a subscriber, think you're a subscriber, could you please resubscribe, smash that bell notification, because guess what? I lose subscribers every day and people don't know my videos are out there. All right, so thank you very much. Appreciate the views as always. So low level price adjustments, basically, and again, you can look, there's tons of articles, look things up. I'm not going to get into the adjustments because there's a whole matrix based on your credit score and how much money you're putting down. Okay, it's a whole matrix on that. But basically, essentially, there's a big difference here. So someone with a credit score of 720 to 739 with a 20 to 25% down payment has a loan level price adjustment of 0.5% or 0.5% before May 1st and 1.25% May 1st or later. That's a whopping 3/4 point difference. Okay, so that's a big hit to your actual interest rate when things work out in the wash. The beneficiaries are those with the worst credit ratings. For example, consider a drop from 3.25 to 250 for someone with a credit score of just 640 to almost 660 with the same down payment. So, obviously that's benefiting the lower credit score person. So that's the big issue. So why should a good credit score person pay more, as they say, for being responsible and just paying bills and being responsible with their finances? Now, of course, this is the type of commentary we're going to get from both sides. So this one little tweet here says, few who are getting the higher fees will notice. It all gets mixed in with the loan. We're a monthly payment nation, so we just want to know the monthly payment. Well, that's your typical response going, hey, the wealthy, the rich, those with money can pay for it. It doesn't matter. Well, you know what? If you're paying more per month for your mortgage, when you multiply that over the course of the life of the loan, typically what do we see? A 30-year fixed rate loan these days. So you know what? The difference in the monthly payment is going to add up to tens of thousands of dollars in difference, okay, that you're paying more for. So in the end, it gets mixed in with the payment. Well, you know what? Would you rather, pay money for no reason and give it away, light it on fire, drop it in the street, or would you rather keep it in your bank account or in your own pocket? That's what it comes down to it. So as Mike Shedlock says here, people will not notice a 55 basis point jump. I beg to differ. The 25 basis point example is not quite right. Charts coming up tomorrow. The idea that people will not notice a 3/4 point hike seems preposterous. Exactly. It will be obvious in your payment. And again, when you go down the path of how many, if we're talking, 30 years times 12, okay, that's a lot of payments that you're making that's going to subsidize somebody else's. So basically, if you're buying a house, it would be smart to default on your credit cards first so you can get a better mortgage rate. And ultimately, this rule to impose fees on home buyers with high credit scores to subsidize access to lower quality credits is so obviously misguided and dangerous. It makes you wonder what the real objective is, which I do have to wonder as well, too. As I mentioned earlier, I do think that, it's becoming more and more obvious that government is stepping into housing. Government wants to control more housing. This really is, another step or another obvious step towards socialization of the housing market. Is this screw job on mortgage pricing even legal? Who knows? We have graduated income taxes, that's legal. We have adult prices versus kids prices for numerous things. We have senior citizen days, but can we legally charge someone more for a loaf of bread if they make too much money? Simply, can we unjustly penalize people because their credit score is good? So again, it's one of those things. I'm sure it's going to be challenged. We're already seeing challenges going on, but as I mentioned, it basically is the first step to all this. And what do? You reach for the moon, you settle for a bit less, right? And then you move the yardsticks and you try it again. This is what's going to be going on as time happens. But from my perspective, being involved, in the housing market for almost 20 years, being involved in the housing market from back in the day, the last housing crisis, and actually having being personally involved with housing policy and fighting, what I was going to say, fighting the government to carve out our special niche in this world for the ability for us to earn income and make a living. That's hard to do, and we've had to fight that. So I'm a little more, what's the word I'm looking for here? I'm a little more predisposed to what's happening in the marketplace. So just where we're at right now, we see a lot of change happening, a lot of stuff going on. So if you're looking to purchase a property and you want to know how to do it and what to do, here's the top 10 ways to earn income and build wealth during the housing correction or housing crash. Now, clearly, we're in a housing correction. There's still debate amongst the mainstream media people. Are we going to see a housing crash or not? Things like what I just talked about don't really help. Lower credit score individuals that jump in the game have proven year over year to be higher default risks. You can look that up. People who use FHA loans, they have a higher concentration, a higher percentage of early payment defaults and defaults on their own and going to foreclosure and losing their homes. Simple as that. So we're seeing this now. This is picking up. It's starting to happen. So top 10 ways to earn income in this housing correction. Well, you can buy at the foreclosure auction. You can go down that path if you want. You can go after the fact, what's called bank-owned, real estate owned. So you can try to go down that path. The lenders are taking back properties through the foreclosure auction. They're going to have ways where they're going to put them on their MLS, the MLS out there for everybody to bid on, or whether you want to go to secondary reserve auction websites to bid, it's up to you, but it's available. Clearly, we're going to see more short sale and short payoff type arrangements out there. My business is increasing dramatically. Lots on the go there. Clearly, we're going to have a lot of what we call taking over someone's mortgage or buying the property subject to the existing mortgage. This is not a mortgage assumption. This is taking over the existing mortgage and making payments on behalf of that person, yet you're taking ownership of the property. All right. We're going to see things like homeowner association and condo association foreclosures. As time goes on and people are getting stretched with respect to recession, the economy, job loss, increased prices, inflation, all those things happening right now, your people default on various parts of real estate. Some of that can be your monthly or annual condo or homeowner association dues, and they will take those properties, those associations will take them to foreclosure to get title back to the property. So that's out there. Tax deed foreclosures, tax liens, and tax deeds. So with respect to, as I said, any economy, it's tougher to earn money. You have people that don't end up paying their property tax for various reasons. That eventually manifests into the potential loss of the property at a tax deed auction. So that's certainly ways to cure that and grab the property, do a deal with the homeowner, or actually buy and bid at the auction. We're seeing an increase in what I call probate/estate foreclosures. Typically, people who are passing away with, say, maybe earlier than expected, leaving behind mortgages, or some with reverse mortgages, that once someone passes away, the mortgage essentially becomes due. We're seeing a lot of those, an increase in those right now. That's a great opportunity. We're seeing an increase in zombie houses, so zombie house properties and zombie house foreclosures. So we're seeing that increase as well too. I've talked about that previously. As the foreclosure market picks up, there's always a percentage of foreclosures that fall into this category, and those are fun to work on and very interesting. Underinsured, what I mean by that is people who don't carry enough homeowners insurance or get caught in situations that something happened unexpectedly that wasn't covered by insurance, or the insurance coverage doesn't pay off or cure what has to be done to the property. So you're stuck with things. You're going to let it go, quick sell, whatever. So underinsured things with fire, hurricanes, water damage, whatever, that's a big opportunity as far as picking up properties for a little less than what's, in those situations they're distressed. And then finally, surplus or also what's referred to as an overage, people who lose their homes to either a tax deed foreclosure or an HOA foreclosure or a mortgage foreclosure. If the final judgment amount, the amount of bidding is purchased by a third-party bidder is above the final judgment amount, that creates what's called an overage or a surplus, and the secondary lien holders are entitled to their piece of the action of that, and so are the homeowners. So overage on their own property. So this is another industry that's sort of out there, but people don't really know about. But ways to help people recover their money because they don't know how to do it. So there's something else for you to participate in. So there's a lot going on in this real estate market with respect to the distressed properties, the ways you can earn income, build wealth, or just buy the house you want to buy. So that's why I say reach out to me. I'm launching my new products right now on this, my new training. This is the opportunity. As I always say to people, I am actually doing this business. Got a bunch of short sales going on right now, closing some this month, onboarding more, the whole bit. It's a robust business. No one's doing the business. That's why there's a huge opportunity. So please keep that in mind. Reach out to me. Let's get things going. I'm offering discounts to get people on board. So if you'd like more information, please reach out to me. That's my email right there. Let's get going on this. Thank you for the views, likes, comments. Please share the video with your family and friends. And if you're not a subscriber, please subscribe and realize that, again, I was really, didn't want to really talk about this for quite some time, but we're kind of here right now. This is what we're facing. The real estate market's changing on different levels, different facets, and we have to be aware of what's going on to participate and figure things out. And again, buy houses, earn a living, do whatever you need to do in this market. So take care. We'll talk to you guys soon.